Hey guys, welcome to another episode of Magnificent Tuesday. And I'd like to start this with a quote from a book, and I'm going to tell you about it shortly. So here we go. So this is the quote from the book. Some of the customers who went seeking slim margin requirements actually intended to act conservatively. That is, they only intended to make a quick turn for a modest profit. Also, they expected to limit themselves to a small loss, but this was more vague in their mind. It is easy to take a small profit, but taking a small loss is frequently just a good intention. Eventually, the customer finds himself throwing in good money after bad until there isn't any good money left. So basically, it talks about the margins that people use, and people who are over leveraged, their intention is basically to make a quick profit, and they use high leverage because they want a higher profit, and in case of a loss they want to cut it out really fast. But that's not what happens in reality. What happens in reality is that once they get into a loss, they keep it, and a small loss turns into a very big loss because, again, like the quote says, they had a vague idea about risk management, but they really didn't implement it. So again, a trader goes in, he's looking to make a quick buck, over leverages, puts on a large number of contracts if it's in futures, and essentially it doesn't go his way, and then he keeps it, and $50 loss turns into 500, 1,000, 2,000, and so forth. So this was a really smart quote about the psychology of people who over leverage at times based on some sort of an impulsive behavior or spontaneous quick take profit when they actually have, again, a very vague idea about risk management. But here's the interesting part that I wanted to tell you about the quote that I just read. This quote was done a long time ago. In fact, it was from a book that published close to 80 years ago. That's right, close to 80 years ago. So, to give you an idea, this book is called Where Are the Customer's Yachts by Fred Schwed. And it was written a long time ago, close to 80 years ago or even more, about the fact that if the markets are so good, where are the customer's yachts? So this is something that you should keep in mind. Now, interestingly enough, some of you might have heard of the book, some of you might have not, but I suggest to read it. But here's the interesting part. Imagine something that was applicable 80 years ago, it's still applicable today. And this is what I wanted to talk to you about, right? Money management was important from day one. It's important since the markets were invented. And a lot of people think that today's environment is different. Today's market is different. What happened 50 years ago, 100 years ago, and nothing changed in reality from the perspective of human behavior and market movements. What does change, right? What changes are the avenues, the technology. So before you had to call a broker, and before you called a broker, you had to attend the brokerage, and before that maybe you had to walk into the trading floor. So the technology became from talking to somebody and putting it on the wall to basically clicking. But the management of the trade still needs to be the same. So a lot of traders today, when they talk about avenues and trading, they talk about HFTs. They talk about algos that stand in their way. They talk about the markets today are more volatile. The markets were complicated from day one. From day one. Since the first trade that ever occurred, the psychology and money management was important. And this is what I want you to keep in mind as you trade. I don't want you to think of the market today, tomorrow, the next day as something that is progressing from a perspective of human nature. Sure, it's trading differently. Sure, this could be more volatility. Sure, there's more participants. Sure, there's more phones today and people trade. But remember, at the end of the day, what you have to do is watch out for risk management and have a plan. And just like a trader 80 years ago, that this author Fred observed that somebody was actually very vague about their trading and didn't know exactly what they're going to do when they over leveraged. This is exactly what happens today. It's not any different. So back in the day, I think he's talking about the period, if I recall correctly, because I read it many years ago. He was talking about the fact when, there was, I think, the Roaring 20s. And in the Roaring 20s, when people were burning dollar bills because they thought they're going to make a lot of money, what happened was that people obviously used a lot of leverage because they see the market going up all the time. So it gets people a little bit excited and everything else. And in the end, we had the crash of 1929. And we have those mini crashes happening today all the time, where we see people are gearing up on certain commodities or certain futures or certain other asset classes, such as stocks, such as the meme stocks, and we see the big drop sometimes. But this phenomena is repetitive in nature, right? It's repetitive regardless of the market. So maybe in 300 years from now, maybe people will trade through their glasses. They'll have this 3D. Maybe they don't need 300 years. Maybe it's the next 3 years, where basically you'll be able to wear a pair of goggles and see charts and click on things through virtual reality, which is fine because obviously, it will change some things from a perspective of excess. So the excess to the markets. But nevertheless, whether you traded 50 years ago with a pencil and you had to, do your own graphs, or whether today you upload the graphs automatically on the chart, the money management rules are staying the same. And this is what you have to keep in mind. Now, in previous podcasts, I was talking about, those people who are always complaining about, good traders versus bad traders, and the not successful traders who blame everything else but themselves and their methods. So let me tie it up all together with this podcast and tell you that every single time in history, whether it was, 2021 now, or if it was 1929 or 1979, there was always a privileged group on the market, whether they had better access to the markets, faster access, better research, better ability to convey things, to read things first from the market. You had floor traders who had maybe some access that others did not have. For example, they would see some big institutions buying and they would see it right in front of their eyes. So there was always somebody out there that had better access than you, better equipment than you. But I don't want it to discourage you. I don't want you to think that group of people will ever stand in your way. So remember, the biggest obstacle you have sometimes is yourself as a person. And so I'm going to finish this short podcast to tell you that regardless of the era that we live, some things are always the same. So just a reminder for everybody that if you're trading futures, and this is what we do at Optimus Futures, there's a substantial risk of loss in futures trading. Past performance is not indicative of future results. I want to give a little plug to my company here, as I always do. Please call us at optimusfutures.com if you want to go to our site, or call us. Our phone number is 1-800-771-6748. We would love to help you. If you're looking for a platform, try out Optimus Flow. Soon we're tying up a trading journal to it. Our developers are working on it, and I hope to release it fairly shortly, so it will be able to track your performance as well. So try out Optimus Flow. It's on our pages there, on the platform pages of optimusfutures.com. Again, we look forward to hearing from you. Call us. We'd love to earn your business. It's 1-800-771-6748. And local, it's 561-367-8686. Just as a last reminder, when you trade futures, please only trade risk capital. Don't put yourself and your family at any risk that you can't afford to have. That's it. And until Friday, you have an awesome week. Take care. Bye-bye.